You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hello, Jim.
Canadians are doing something really silly, do you think? They're investing in stocks with borrowed money because borrowed money right now is cheap. Is that a good deal?
No, it's a nightmare. Honestly, it's a strategy that's commonly sold by the risk sellers and the debt sellers to tell people to lever up, either borrowing on lines of credit or borrowing against their house, increasing their mortgage. And the logic goes rates are low, so you can use all that money to quote invest. The problem is they're doing it at record highs in the stock market, 6-year highs. Doing it at the bottom of a market cycle, like 2009. Would be risky enough, but doing it after things have gone up the way they are and the way that they're overvalued today, it is a recipe for financial suicide. So I was writing about that because there was an article this week that came out, Canadians find a new way to binge on debt as borrowing to buy stocks hits record high. That was in the Post this week, actually yesterday, and I just thought, oh dear, here we are again, And the problem is that most people get their advice from commission salesmen, and oftentimes they come from banks, which are conglomerates of both debt sellers and investment dealers. Same thing goes with some of the financial planning organizations. They have affiliations with banks or lenders, and they're working in concert in this neat little a referral circle that says, hey, you help us sell loans and we'll help you sell commission-based financial products. So the poor gullible investor or homeowner or borrower in the middle gets the shaft because they are, they take out debt thinking that, and the logic goes, hey, you can get this money at a low rate of interest, 2.8. Why wouldn't you do that when you can get, buy these stocks that are yielding 2.7, and then they'll also go up and it'll make you wealthy on top of that. Meanwhile, back on the range, it's quite more likely that stocks will decline a great deal in value. So, the debt will stay constant. And then what happens is people panic after they've lost a big chunk of the capital, and they have to sell, or they move to sell the assets, or they're holding margin accounts where you're actually borrowing against a stock portfolio at your broker-dealer. The broker-dealer charges a nice amount of interest to you in advancing those funds, so you're paying that interest, and you have to keep your ratios at a certain level. So, of course, as soon as the prices begin to fall, you start getting margin calls. Every day you have to either add cash or sell assets to pay down the margin balance. So it's just this capital incineration machine. It's awesome to behold if you've ever seen it in first person. But anyway, yeah. So it's traditionally a sign of great market mania when people are widely, thinking this is quote savvy to be borrowing to invest. Borrowing to speculate, and I make the point, why not mortgage your house and buy a bunch of lottery tickets while you're at it? Because essentially that's exactly what people are doing. So anyway, I always like to write about that when I see that in the press, because it's one of those things, if you could get that word out, if you could send that to someone you love or know and care about and get them to not do that right now, or to sell whatever they've got and pay off those loans before the loss cycle hits, then that would be something they would probably thank you for the rest of their life. So anyway, it's just one of those things where, it's sold as quote financial advice, but it's actually just about getting commissions up front for the sellers, and the person that's taking the advice is left with gaping holes in their net worth at the end of the day. So
I know the investment advisors at banks say they're independent, but all they'll sell you are the investment instruments owned by that bank.
Honestly, they're not independent in the slightest. In fact, none of them, even the ones who sell you other products, traditionally, I saw that the head of a ETF company was on Bloomberg this morning. Now, the reality is that those guys make more fees when people are holding equity-based ETFs than when they're holding any other kind. So although they may say to you, we have a full complement of products, we have money market ETFs, we have treasury ETFs, we have corporate bond ETFs, we have all these lovely equity ETFs wrapped all these different colors of stocks and indices. The reality is their fees are about double and triple collected on the assets that they can steer towards the equity side. So even though they may say, hey, you know, we're in the business of managing wealth and we don't have any incentives, it's like, well, actually, you make double and triple as much if you can get people into equity. So guess where their bias naturally lies when they're in a corporate structure that wants them to have, you know, nonstop quarterly increases in their revenue and their earnings. So, yeah, it's a very seedy world, I'm afraid, and there's no wonder most people get it wrong. No wonder most people get heinous advice that harms them over time. It's all, you know, whether a person acknowledges their conflicts of bias or not, they, you know, this is the reality, and that's why people get hurt.
Do people have very short memories? Because I look at some people who they reelect and I say, you forgot about all the bad things they did, didn't you?
Yes. Well, people have short memories. I also think people don't understand at a deep level the mechanics and influences involved certainly in investment, quote, management or investment planning, financial planning. It's a mystery field. It's math-based, which often gets people sort of blood pressure up just thinking about something like that, math-based. Then it's fear-based because people are concerned they don't have enough for retirement, and guess what? Most people don't. So they you know, look for someone to give them an answer, like, you know, here. And the greater the certainty this person speaks about, you know, the certainty of outcomes, the more they're attractive to the sort of unwitting, and that's what attracts them to the wrong advice, frankly. So yeah, it's I guess part of the human dynamic. I don't suppose it's going to go away, but Canadians are, as you know, already at the highest debt levels that they've been at ever, and now they're also borrowing to buy stocks at the highest reckless valuations pretty much in history, except for a few months in 2000. Dividend yields are the lowest because prices are so high. So you really couldn't have a worse time to be doing stuff like that.
You mentioned that in the Canadian stock market, we hadn't done what they did in the U.S. The stock market still hasn't got back to the value it had before the last crash.
Yeah, it got close, but it's well below that now. Yeah, it's because we are a much smaller market. We have much less you know, market cap, much less individual securities that can be traded with any volume. So we haven't been as attractive to the algo churning HFTs, which drive 50% approximately of the quote volume, so to speak. The vanishing volume, I call it, in the U.S. markets is driven by these algo trading firms, which trade off headlines essentially. They don't have anything to do with fundamental valuations. They trade off what they think will be popular taglines. So you see great fervor of you know, buy sell, but really they're just a bunch of canceled orders. It's a kind of a mirage of participants that take place in the HFT sphere. So Canada doesn't have the same degree of participation there. So we haven't had the same overjuicing per se, but our valuations are heinous at the moment. I mean, considering that the Canadian economy contracted in Q1, we just got news of that this week, that the oil revenues have plunged the way they have. You know, our Bank of Canada governor is warning that this is outrageously bad for Canada. We're seeing it pick up in all the data. We saw it even in the U.S. data this morning, right? You've got new orders in the U.S., which is a pretty reliable recessionary indicator, new factory orders in the U.S. Now, the headline, this is the kind of world we're in. The headline was that factory orders increased 0.2 in February after falling for 6 consecutive months, so that was considered good news. So you get this sort of a spark off that headline where the algo machines start firing away and you see a big race ahead in the stock index out of the open. But the fact of the matter is that although you did have this mild 0.2 increase in February, in the prior month for January it was revised down to negative 0.7. So all these numbers are fungible and always, you know, altered in retrospect, and typically they come out higher than they end up being. So U.S. factory orders for February came out slightly positive, and that set off this rush of positive momentum in equity markets at the start of the day, but as you read through, you see that, in fact, the prior months that had been reported as a slightly negative 0.2 ends up being a much more negative 0.7. And now U.S. factory orders have actually contracted year over year by 2.3%, Jim. And every time that's happened, you have already been in a U.S. recession. So I put that chart from the St. Louis Fed on this morning, the value of manufacturers' new orders in the U.S., and it goes all the way back to 1990, and it shows that every time you have had a contraction of this magnitude year over year in new orders, it is already in recession. It was in 2001 and 8. And the reasons are quite many. It's not one little thing here that's causing a bugaboo for growth, and it's really worldwide, and I say broad-based and persistent, because it's, you know, some of the things we're writing in our client letter at the end of this month, this week. But basically, manufacturing's been hit by this strong dollar, you know, the strong U.S. dollar. So this means that goods are much more expensive to purchase for exports to other countries. They're having a harder time affording U.S. goods. They're buying less of them. It also means that U.S. people that have spending money are more inclined to buy foreign goods rather than domestic goods, which also hurts manufacturing orders in the U.S. because they have a stronger dollar, right? Don't forget. So they can afford to buy things abroad and look for value that may transfer back because of their stronger currency. So it really hits manufacturing in a double whammy. You know that crude oil crashing has been a major impact on so much to do with expenditures, projects, and capital spending and all that sort of thing. That's all been negative. And you've also seen, you know, all sorts of labor disputes breaking out. You know, the West Coast port business in the U.S., that's been negative for shipments. And so you've got a bunch of stuff, and not to mention, of course, China's slowing much faster than people had thought. Europe is, again, back on the ropes. So it's really a worldwide phenomenon, this slowdown, and that's what's sort of showing up in the data week after week after week.
We'll have more with Danielle Park right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking to Danielle Park, editor of the popular blog Juggling Dynamite. Check it out. Very interesting articles. Danielle, I've heard about a new way to manipulate. Maybe it's not so new, but you know how CEO salaries so often are connected to their stock prices and so on. One of the ways companies are trying to look good is that they overestimate what their earnings will be, or underestimate, so that if you beat the estimation, people think you're being successful. But the figure that they gave you to start with was an artificial figure that doesn't mean anything.
Well, this started, you know, really in the early 90s when companies became very forthright or aggressive, let's say, in forecasting and having these quarterly earnings calls. So really what it did was, I think, it's very devastating, I think, because analysts who are trained and schooled on how to do objective assessments of financial statements became more and more inclined to listen to the quarterly call and go to management for forecasts of what they saw going on with their business model, which may sound intelligent, but when you realize that the CEOs are the head salespeople for their company and their job is essentially to keep the game going, keep people believing and buying their product, and always sort of take an optimistic bent. That's their job, really. So what happens is, over time, analysts became less inclined to do their own homework and the discipline of their own measurements and develop their own sort of analysis skill, and more inclined to rely on the representations given by management. So you had this groupthink evolve, and what happens is that the street then consensus becomes sort of incredibly unified, incredibly similar, and so you know, they sort of wait for each issuance from the corporations about what they should expect. So they begin the process of dumbing them down, you know, weeks in advance of their quarterly reports to sort of say, hey, you know, we expect earnings or we expect sales to be lower than we thought, et cetera. And then if they can do some kind of creative accounting, which has been a huge amount of the reports, because if you look at all the global data, if you look at all the actual demand indicators, it all peaked in 2010, and global manufacturing, everything, and has been declining steadily ever since. So what companies have done in the face of that is say, wow, I don't see any growth areas that are very robust. I don't see strong demand, strong final demand anywhere. So what are we going to do to keep hitting these earnings targets? I know, let's warn that we see this slowness or downtrend in our sales and revenue expectations. However, in the end, we can borrow money at these low rates, buy back our shares, and surprise to the upside. Because by absorbing the shares that are already on the market, they can, reverse engineer a beat in earnings per share. And they've been doing that. So that's been the go-to tool, which may again sound brilliant and, harmless and all that good stuff, except when you realize that now they are up to their extras in debt. And they're coming into the downturn much like the central banks of the world, already with, rates at zero and the most debt they've ever had. And so their flexibility coming into the downturn is much diminished because they don't have, strong balance sheets, low debt levels, and high cash on hand. They've literally sort of burnt that cash, where they could have kept it for strategic acquisitions when the sort of price reversion comes, when everything sells off, when the next recession comes, when the next bear market sort of brings all these fire sales. If they had retained cash power, they would have the ability to buy up weaker players and really create long-term strategic value. But unfortunately, everyone's been so incented by short-termism instead of long-term investment that they've really wasted a ton of potential and money and brought forward whatever demand, we were going to see in the next few years into the front of the cycle. So we just keep getting to the future with more disappointing data, with weaker sales and earnings than people had hoped, and, with increasingly less financial resilience because we don't have, as I say, the cash on hand or the low debt levels to really take advantage of, buying when things are going to be low again. So anyway, the Fed is, now stuck in this corner where they are trying to sort of fool everybody all the time, and you really can't fool everybody all the time. The bond market's bond yields have been selling off again in the past couple of months. The 10-year's well below 2 again. It was 1.87 there in the last couple of days. So that just tells the world that that slow growth is coming full steam ahead here, and the Fed's already cut to zero. They're trying to save face by saying we're going to have to hike rates soon, but I understand why intellectually they're insisting on that, but I think fundamentally, again, if you look at the actual state of the economy, they really have put themselves in a very difficult position because they have no prods to offer here at this point.
Anything else, Danielle, you wanted to throw in on this?
I'm just, I guess I'm encouraged that things are going pretty much the way we had expected them to go based on the demographics and the debt and the general structure of what went on after the great financial crisis. I guess I am a little concerned about, how bad it could get this time because I know that all the, the stimulus efforts and cash has been spent. On the other hand, I'm encouraged because I know that, you really can't make water out of a stone or out of nothing, and they're going to have to just sort of put up with the mean reversion that's coming, and I think that will be a very cleansing time. I just don't want people to not know it's coming and to be taken off guard. And I think, the ones who are borrowing to invest right now are holding a high equity proportion of in their savings and not realizing that this downdraft is totally due any day now. Those are the ones that may have lasting harm from all this. And anyway, I'm just trying to alert people so that can be avoided as much as possible.
What's the smart money doing if you want to grow it? Or is it just a matter now of keeping what you have and not losing it?
Yeah, that's the art of this cycle, is to keep what you have, to grow it steadily over time, and to not have a lot of risk exposure, because risk is probably the highest we've registered it ever in, maybe ever in human history. So it's across pretty much every asset class, and it's not the time to be aggressively insisting on X% return. It's the time to be carefully protecting and keeping capital safe and liquid.
Danielle, thank you very much and have a great Easter.
Yes, happy Easter to you too.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her website is jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net and check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.